Welcome back to Investing Talk Podcast.
Today we're looking at SanDisk.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We are charting a fascinating market pivot today. The story here isn't just about the general, painful memory cycles of the past. It's fundamentally about the AI infrastructure build-out.
Right, the massive global effort that's kind of reshaping the whole semiconductor supply chain.
Exactly. And SanDisk recently reported a truly formidable Q3 2025 result that really underscores this shift.
Okay, let's unpack this. We've seen the numbers. $1.22 EPS and $2.31 billion in revenue, both handily beating expectations. A revenue beat is good, but in the volatile memory space, the market is always looking ahead. What's the fundamental change here? Are they actually confirming this growth is sustainable, or was Q3 just like a temporary peak?
They confirmed sustainability, and this is crucial. They provided positive guidance for Q2 2026. And the reason is very specific. It's driven directly by this surging structural demand for NAND flash memory.
The kind used in AI and enterprise applications.
Exclusively. Now look at this figure. Their gross margin is sitting robustly at 27.9%.
Wow.
For a company that's historically been prone to commodity pricing swings, that margin is flashing green lights. It shows they have significant pricing power in what is still a very tight market.
27.9%.
Yeah.
That, like you said, suggests real financial resilience. They're selling on value, not just price. But a high margin doesn't mean much if the rest of the business is shaky. What does the balance sheet look like?
It's far from shaky. The liquidity position is, it's exceptionally healthy. We look at the current ratio.
Which measures their ability to cover short-term debts.
Right. And their ratio is 3.3. To put that in context for you, the industry standard for hardware is often around, say, 1.5 to 2.0.
So 3.3 is huge.
It's a fortress. It signals they have a solid, almost conservative ability to cover all their immediate obligations. And this financial stability is strategically vital. It supports their capacity to reinvest heavily in their next-gen memory, the BiCS8 NAND development.
And that's absolutely critical for keeping their edge.
It is.
Here's where it gets really interesting for me, connecting that R&D spending back to the competition. SanDisk's edge seems overwhelmingly tied to that BiCS8 technology. What exactly is it, and how does it give them a measurable advantage?
BiCS is their proprietary 3D NAND architecture, and the 8 is just the 8th generation. The strategic value is all about layer density.
Layer density.
Yeah, think of it like a skyscraper. They are dramatically increasing the vertical stacking layers, how many floors they can build. That translates directly to a lower manufacturing cost per gigabyte compared to rivals still on older generations. That efficiency is the foundation of their ability to hold that 27.9% gross margin.
So their intellectual property, their IP, it positions them perfectly for the highest demand areas, like data center SSDs and AI accelerators.
Exactly, and they're also benefiting from a massive market disruption happening upstream.
And those trends are just fierce right now. We saw the news that major competitors, I think it was Samsung and SK Hynix, are raising prices for high bandwidth memory, or HBM, by almost 20%. I mean, due to supply constraints. That's a massive jump.
It is, and this is the core structural catalyst you need to understand.
So how does prioritizing HBM by their rivals, which SanDisk doesn't even make, how does that directly benefit SanDisk's NAND business? It seems a bit counterintuitive.
That is a crucial question, and it's all about supply chain physics. HBM production is extremely complex. It requires vast amounts of the industry's most precious resource wafer capacity. So when the big players prioritize HBM for AI accelerators, they are diverting that capacity away from producing standard NAND flash.
So effectively, the demand for the most extensive memory, the HBM, is starving the market of the bulk storage memory, the NAND.
Precisely. It creates an artificial structural seller's market for NAND, and it looks like that's going to last well into 2026. This shortage directly fuels SanDisk's already strong margins.
Especially since they're focused on the enterprise segment, which is less about price wars.
Right. They're insulated by the sheer magnitude of enterprise data needs.
And the market is certainly responding to this. Let's pivot to the stock price. The surge right after those HBM price hike announcements was.
Right.
It was dramatic. What did that tell you?
It told us the market understood the dynamic we just talked about. Shares surged, 11.56% almost immediately. It confirmed a sustained high conviction uptrend. We are looking at year-to-date gains around 578%.
578%. I mean, that's explosive. That kind of return, though, it screams bubble risk to me. Are the fundamentals keeping pace with that stock price, or is this just excitement?
It's a mix, but the fundamentals are catching up, and fast. The Q3 beat suggests they're monetizing this shortage. But the technicals are also confirming institutional belief.
Okay, so are we seeing signs of accumulation, or is money flowing out after such a big run-up?
The signs point decisively toward continued accumulation. Short interest. So the bearish bets against the stock, it actually declined by 3.0%. It's down to 7.43% of the float. That is significantly lower than the peer average of 9.92%.
This is the bears are giving up.
They're covering their positions. And we're also seeing what analysts call constructive momentum. There's a potential golden cross forming.
Okay, for the listener, a golden cross is when the short-term moving average crosses above the long-term one. A bullish signal.
A very bullish long-term signal, yes.
And it's not just retail interest driving this. Cluster buying by institutional investors is a massive sign of conviction. Who are we seeing making these moves?
We've seen significant capital flow. Romano Brothers, for instance, initiated a pretty big position. Even more telling is the confidence from public pension funds.
Yeah.
The Virginia Retirement Systems invested over $4 million, snapping up 36,000 shares in Q3.
When you see state retirement funds buying in, they're looking past the next quarter. They're betting on a structural change.
That's it. They're betting SanDisk is now an essential infrastructure player, not just another commodity supplier.
And on top of the money flowing in, there's also movement on the governance side.
Yes, absolutely. The board is strengthening with the appointment of Alexander R. Bradley. He's the CFO of First Solar. His appointment becomes effective December 30, 2025. This expands the number of independent directors, which the market generally loves. It adds a layer of established financial discipline.
Okay, so we've covered a lot of phenomenal upsides. The margins, the AI demand, the institutional buy-in, the tech lead with Buy CS8. But let's talk about the downside. We have to look at the risks. Despite all the positives, we saw that little 1.2% dip at year-end. What are the primary concerns that could derail this whole story?
The key immediate risk is earnings volatility. It's ahead of the Q2 2026 report on January 29th. The expectation bar is just sky high now.
So the market will be scrutinizing everything.
Everything. First, the sustainability of NAND pricing. If they hint at any price softening, the stock will get punished. Second, their inventory levels. A buildup would signal that ghost of cyclicality is back.
Let's expand on that. What about the structural risks? Is that technological moat, their Buy CS8, as secure as we think?
That's a very real threat. The risk is that a competitor, maybe one of the huge integrated giants, launches a newer NAND generation that suddenly closes that cost per bit gap.
If they get leapfrogged.
Exactly. If a rival can leapfrog Buy CS8, that 27.9% margin could erode very quickly.
And what about their customers? SanDisk mostly serves the hyperscalers, right?
Mm-hmm.
The Amazons, the Googles of the world. Could they decide to just make their own?
The threat of vertical integration by hyperscalers is maybe the most existential long-term risk for every memory supplier. If just a few of those huge customers decide to build a portion of their own capacity, it could really soften the entire pricing environment.
And going back to the memory shortage itself, you said it's a benefit now, but if the big players keep prioritizing HBM, could that eventually squeeze SanDisk's own access to wafer capacity?
That's a valid concern, particularly on equipment lead times. However, SanDisk's focus on high-margin enterprise demand plus those strong gross margins, it gives them a buffer.
They can afford to pay more if they have to.
They can. And they extract more value from every wafer than rivals in the consumer space. The narrative seems to be that their strong growth and supply discipline help mitigate the worst of that crunch.
So let's summarize the timeline. Looking forward, the next 3 months are critical. What are the specific catalysts we should all be marking on our calendars?
The single biggest event is that fiscal Q2 2026 earnings report on January 29th. The entire focus will be on whether the AI growth, the NAND pricing, and critically, updates on Buy CS8 adoption rates confirm the bullish outlook that's already priced in.
And beyond the numbers, we have the qualitative stuff, like the new board member Bradley coming in after December 30th. That could lead to strategic announcements.
And we can't ignore the speculative fuel. There's constant chatter about massive hyperscaler engagements. Talk about the memory needs for future AI projects, like OpenAI's rumored Stargate initiative.
A multi-billion-dollar supercomputer project.
Right. If projects of that scale need that much NAND, it could accelerate pricing momentum across the industry well into 2026.
So what does this all mean for you, the listener? When we put all these pieces together, what is the final, refined, takeaway?
The takeaway is that SanDisk is ideally positioned at this intersection of tech advantage and structural market shortages. This isn't just a tide lifting all boats. AI tailwinds are forcing competitors to divert resources and hike prices by over 20%, which is creating this huge protective price umbrella for SanDisk's enterprise NAND business. And this competitive relief, it's what fuels those phenomenal gross margins, justifies their strong Q3 results, and drives the conviction we see in that institutional buying.
That paints a very clear picture of how AI infrastructure demand is generating an essential moat around a traditionally very volatile business.
The crucial element for you to track now is how successfully SanDisk converts that tech advantage in CS8 into sustained, verifiable market share gains in data centers. That conversion rate is the factor that will determine if this run-up is just a cyclical spike or if they have truly evolved into a premium multi-year growth holding. And beyond that, you should explore the horizon of next-gen memory technologies like CXL or MRAM, and whether those pose a long-term threat to NAND's dominance. That's what will redefine this whole sector 5 years from now.
Excellent analysis. Thank you for walking us through that intricate story. Make sure you hit that subscribe button to catch our next analysis, and we'll see you in the next show.